Hi, thanks for joining me again. This week we're going to look at the chart. When you look at a chart, especially for the first time, you're looking at the history of the sentiment in the market for a certain stock or a commodity or a currency. The chart shows a story, and you need to interpret that story using the spread or range of a bar, the position of the close, and the amount of volume on any particular bar in any particular time frame. This story continues to unfold as you watch this chart, and you need to be able to adjust the story to any changes in sentiment, because it's a story about the market's sentiment for the stock, commodity, or currency. You need to be careful not to interpret how you want a stock to evolve, and instead just look at the actions on the chart of the market and put into words what you see unfolding on the chart. You use certain principles that will help to guide you. You can see on this chart, prices moved higher from a very low base. This is a very large bar here that's closed up near its highs. This is all really one big consolidation pattern. All of this is a consolidation for this rise in price. Whenever price rises sharply, it'll draw out supply, profit takers, people who bought in at the lows and they're taking their profit. The market needs to absorb. So we can see on this chart, this is a big consolidation pattern for this rise in price. You can see from last week, here's some testing just below this low of the range. And you can see on the end in the last week, this is a weekly chart. This was a basic test, you might call it. It's a mini shakeout, and it's closed slightly higher than the previous bar, but the majority of the trading was done below the previous close. You'll see here, this was an attempt at a test, and the volume was low, but half the trading was above the previous close. And a test should be having the majority of its trading below the previous close. So then there was a secondary test, volume was even lower, and spread was even narrower, and then price attempted to push away. You can see here that price closed at a level where previous supply existed. This is previous supply here. So it's closed at quite a logical position. And this in the last week, there's been a shakeout, a mini shakeout. And volume was lower than the up bar previously. You would expect this price to move higher or put in a secondary test. You may find a secondary test is the highest probability, but it could push higher from here. Reading the unfolding story on a chart is important. It's important that you understand these principles so you can put the actions of the chart into words, into a story that's understandable. We'll switch to the daily chart of the same stock. You can see just recently that price accelerated away, then it's come back. After accelerating away, it's come back to consolidate this rise in price. You can notice that this bar is slightly narrower in spread than this bar, but interestingly down here, volume was only low to start with on this bar, but volume was almost double on the second bar, but yet spread narrowed. The only way to explain that is to say that there was quiet buying at previous support. Here's the previous support. There was quite buying coming in, and that kept the spread narrow and increased the volume. And then to confirm that, price was up the next day, albeit on low volume. This bar actually looks like this. And then this next bar, it's hard to interpret. I actually went back and had a look at the intraday chart. What actually happened was price moved lower initially, and then it moved up to the highs of the day, and then it drifted lower into the close. And there was volume as price came back. There was volume then as price accelerated higher, and there was very little volume as price drifted lower. This was a test initially where price came back. It absorbed the supply that was drawn out as price pushed lower. Anyone who was willing to sell or was worried or concerned that price had come back to previous support after it accelerated higher up here, you got those nervous Nellies out of the market. The price was absorbed. Then price was bought up. The offer was bought. It was a buy the offer situation as price accelerated higher, and then it drifted lower into the close where there was little support being given, but that is what the market wanted at the time. It had taken out a number of people, absorbed their supply, and then as price drifted lower, there was an indication to the market there was no more sellers there. Sellers were exhausted. And in response to that, price accelerated higher, only modest volume the next day. That was because price could accelerate higher easily because anyone who was going to sell appears to have sold the previous day. There was very few sellers in the market, and the price was able to move higher relatively easily on lowish volume. So you see how you read the chart as it unfolds in front of you. There'll be times when something will change and what you're reading doesn't make sense, and either you didn't read it correctly in the first place or sentiment changed in front of you, because sentiment does change. The market has a certain sentiment. If you go back to that weekly chart, the market sentiment certainly changed from here to go up like this. There's a change in sentiment. If you've read the chart correctly and then sentiment changes, that's not your fault. You just have to interpret the change in sentiment. Time goes on, you need to interpret whether the market is still having the same sentiment it previously had, it's maintaining that sentiment, or whether sentiment's changed. Sometimes you'll take a trade and you got everything right really, but something happened at the time you took the trade or soon after, sentiment changed, and really you got it correct, but the market sentiment changed and then you were caught out. You may have been going long and then the market's turned, changed sentiment and gone back down. It wasn't your fault, you read it correctly, but you just happened to be right in at the time when, for whatever reason, the market sentiment changed, and then you have to be willing to accept that change and get yourself out of that position. So reading a chart by its own actions and understanding the changes in sentiment on the chart, understanding the principles involved, will help you stay out of trouble generally and put you in the right trades at the time. It's just a matter of understanding the principles and putting them into work as you read the story of the chart as it unfolds in front of you, using the spread of the bar, the position of the close, and the amount of volume at any particular time in any particular time frame. Okay, it's a short one today. Hopefully that was helpful. See ya.